I've said time after time on this channel that in this modern information age that we're in, that it is no longer about the quality of the product. The actual monetary value is just to get you to buy in to the product. Meaning, many financial products and investment products that you see marketed and targeted towards you, in most cases, are not of solid quality. The majority of great financial products and great financial investment products are often gatekept. And the difference distinguishes whether or not the actual product or investment is of quality or not, or if it's intended to have a low barrier of entry so almost anybody can get in, with under the folklore of democratizing it, making it available to the masses. The truth be told, for as far back in time as humanity as you can go up to current day, the majority of quality is gatekept. There's barriers to entry. This video is intended to help give you the top key resource to becoming a quality investor by sorting out what is a quality investment. I'm going to give you that formula in this video so you can stop feeling enticed to buy in to every glamorous ad or commercial that you see targeted towards you, trying to get you to put your money, your time, and your effort into something that's not really meant to work for most people anyway. This is JP from Blueprint for Prosperity. We're gonna get straight to it. So in this video, again, the intent is to teach you the number one key or the top formula for you to be able to sort out quality investments and be successful as an investor. It's not rocket science, but it is very important that you have an understanding of it because it is lost in translation with most products, services, and marketing out there, completely skipping over this one key to success. That being understanding the delta between your cost of capital and your earnings in an investment and what makes that investment work. So we're going to extrapolate that in this video. Your cost of capital is the foundation of you being a successful investor. You need to be able to get your hands on money to invest. There's many concepts out there that have been thwarted of this idea that you can work your way into investing from your back muscle, basically from your hustle. Examples of that might be wholesaling. It's often deemed as a real estate investment option. It's a transaction. It's not an investment. You are actively participating in it and earning a fee at the end of the transaction. That is not an investment. That's a transaction. An investment is rental real estate. You make a one-time purchase. You may continue to have to manage upkeep on it, but ultimately it's operating largely without you. That is one of the distinguishing differences of an investment versus a transaction. Fix and flipping is another one. It's a transaction. Yes, you're making an investment of capital into a property, but the entire process is largely pending upon your work of getting it done. And you get a one-time fee when that transaction is complete. Not the same thing as investing. Let's get that out of the way. Your cost of capital is very important to understand. And we're leaning more on the money you're using to invest, and many times is borrowed money. But if you're thinking about like the stock market or something like that, then this obviously could be stored up capital. But even in that case, I'm going to give you an analogy to help you make sense of what that cost of capital, even if it's money that you earned or worked for. Your cost of capital is the foundation. You need to understand how to get your hands on money, and ideally how to get your hands on money at the lowest price possible if you're borrowing it. That is the whole point of building your credit. Literally, the foundation of that is making sure that you have a strong financial reputation and quality relationships with banks and lenders so they feel comfortable lending you money and at a low return. Basically saying, okay, this person looks reliable. I'm comfortable. I'm going to get my money back over a long duration of time. So I don't need to charge them as much because they're not as risky. I'm likely to get my capital back. So they're willing to give you that cost of capital at a lower margin. That's fine. That's what you're after. The same thing applies if it's money that you work for. You want to get your hands and start saving on as much capital as you can to get into investments. The cost of capital on that is what we're going to extrapolate in a few minutes. So Once you understand your cost of capital, once you get to the point where you're efficient at getting your hands on capital at a low cost, your goal is now to go out and find an investment that earns more than the cost of that capital. Now, this is the next portion that most people are getting confused or are completely misled about when it comes to investing, because everything's packaged to be so sexy now in this quick opportunity at passive income, quick investing strategy to make you a millionaire overnight. What people don't understand is how to determine what makes an investment work. What does that mean? We're going to give a few different analogies, okay? Let's just say we'll start with an energy company. You're doing stock, let's say you're a stock market investor, or you're an aspiring stock market investor. You've gotten your hands on some capital, whether it's earned or saved capital or really, really inexpensive debt. You decide to invest in the stock market. Generally, it's not recommended to invest in debt. Use debt to invest in the stock market, but that's a different conversation. The more of the stories you have capital, you're looking for quality energy companies to put that capital into. That's the sector that you have an understanding on and that you're interested in. What you're looking for is what's going to make a particular company or basket of companies work. We'll give an analogy, a quick story. Let's say that the conflict in Ukraine, right? We'll just say that the Russians are, world's top producer of a particular energy, we'll say gasoline, oil, whatever the case, we'll say oil. And they are supplying, Europe and most of the Western world of oil. They go to war with Ukraine, the West doesn't agree, they sanction them, and they're not allowed to trade that oil out for the currency denomination that it's normally traded out for, not allowing them to basically trade in the West that oil anymore, right? Let's just go with that. What you're looking for as an investor is now saying, okay, what company is going to have to step up and fill that void now that there's a massive shortage of a particular good and a high demand for it? So now you do your research and you run across a domestic oil company. We'll just call it Shell Oil in the United States, whatever. And you find out they're the next in line, or they're going to be one of the next major companies in line to fill that void in that high demand. They're going to have to produce much more oil than they're used to producing. They have a much larger customer base to reach now. That's going to make them inherently more valuable. So you need to understand that kind of concept when you're looking for investments. What is going on around me economically, politically, socially, that is going to make something more attractive? That goes into the concept of valuations on these companies. What does that mean? The value of that company. As I just said, I gave you a quick analogy, a made up analogy of how that company is going to become significantly more valuable overnight due to geopolitical risk and circumstances. The valuation of that company. Let's say that same scenario breaks out. That company steps up to have to start producing more oil for the United States and for Europe. And for some reason, something happens domestically, economically in the stock market to cut the value of that stock of Shell Oil, that energy company we selected, in half. Let's just say it was normally trading at $100 per share, and something happened where it got cut down to 50 for whatever reasons. Naturally, psychologically, unfortunately, most of you, if you were investing in that, are not savvy enough, would see that as a red day in the stock market, and you're going to be terrified. You're either going to be nervous. Some of you are even going to withdraw your money out thinking that this thing's going to collapse to zero. Understanding how it works and what makes it valuable keeps you from being emotional. Why? Because what happens is that company is technically worth $200 a share, roughly based on the geopolitical circumstances we just broke down a little bit earlier in this video. That's on paper. That's something that you can put the math together and say, this company should be worth somewhere around $200 a share. I bought it at 100 and it went down to 50. If you're not educated, guess what happens? You see it go down to 50, you panic, you sell it, take a loss, and miss out on one of the greatest investment opportunities that may be available to you at that time. Smart investor sees this company and says, well, I bought it at a discount at 100. It just went down to 50 and I know it's worth 200. This is a phenomenal buying opportunity. This company just became 50% or 100% that more attractive, because it just went down from 100 at where I bought it already at a discount down to $50 a share. I need to be dumping more money into this because I know ultimately it's going to have to go up to its true valuation at some point in time, which we agree at this particular analogy is $200 a share. Same concept in real estate. You decide that you want to get into rental real estate, right? What's going to make rental real estate work in today's market? At the time of this video, we're going to go with the current circumstances. There's a higher interest rates out there, but even with higher interest rates, in an attempt to suppress the increase in pricing for houses, there's an even bigger inventory issue for housing. Millions of homes short. So what does that mean? Well, let's hypothetically say that you go to invest in a duplex in your local market. The Federal Reserve makes an attempt to compress interest rates and cool down the buying market, which gives a temporary slight on the value of that property. But you know that there's a massive inventory shortage and that the population is still growing. That ultimately means that if whatever the value of that property at the time you purchased it, you know that it can only do one thing ultimately at some point in time based on the overall market conditions. It has to go up in price. There's significantly less homes competing with my home, and there's going to be increasingly more buyers or renters in the market as time goes on. Inherently, intrinsically, my property has to become more valuable. So I just need to borrow my money cheap enough. If today's fixed rate are 6%, and I get my hands on that for 30 years, and I can get, let's use this as a rental, and I can continue to increase the rent 3-5% a year because the market that I bought it in is attractive enough. People want to live there, and it's in demand because there's not as many houses in the market, and there's an increasing market of renters looking for housing. So I can mathematically look at this and say, shortage of homes, surplus of renters, and that's going to equate to this home being worth more at some point in time, or validate the demand for an increasing rent on an annual basis. So that means that compounding, I'm earning more than it's costing me. I have a fixed 6%, but I'm getting an additional 3, 5%, 6% per year on that money. If I keep that game going over 30 years, I can assure you it does. No matter how much that 6% is costing you on that mortgage, you can look at an amortization calculator all you want and get sick to the stomach because you're probably going to pay 2 times for that house. But those renters, those tenants are going to pay you multiples of that over time, compounding. I hope that makes sense. I hope you guys are following that, because I promise you that is one of the most fundamental values of value investing. Is one of the most important principles and keys of value investing. You have to understand the concept of getting your hands on cheap capital. And I'm going to quickly extrapolate when we talk about getting your hands on money you earn. This is another simple one that's taken for granted. If you earn paycheck, wherever you get this money from, you worked for it, right? That means you didn't borrow it, so you don't have debt attached to it and interest. Your cost of capital on that money is now inflation, purchasing power, the loss of purchasing power. You need to find somewhere for that money to go that's going to exceed the cost of inflation. Meaning, I worked, got a paycheck, that money's sitting in my bank account, and it's costing me 5% a year on that money. I'm losing 5% a year of value, of purchasing power on that money. If I sit it in a bank and that bank account is paying me, let's just say 1% in a savings account, that means I'm losing 4% in purchasing power on the value of that money. Does that make sense? Are you following that? I had this money, I earned it, I have no debt on it, but inflation, a natural economic phenomenon called inflation, means that my money is guaranteed to be worth less every year by a certain percentage. At the current moment, it's roughly 5%. Overall headlines numbers is 5%. You don't have to understand the details of inflation if you by chance don't know and you're watching this video, but what you need to understand is that your money is losing 5% of its value every year. Your job is to find somewhere to get it more than 5% per year in order for it to keep up or exceed its loss in purchasing power. And what you need to do is find an investment or a deposit vehicle that works. And why does it work? Right now, deposit rates are actually competing with, and in some cases, nearly exceeding the cost of inflation. What's behind that? The Federal Reserve is increasing interest rates. When the Federal Reserve increases interest rates, it forces banks to increase interest rates to continue to keep it attractive for their depositors to keep their money in deposits. So when that happens, then now the banks, the Federal Reserve said, well, the federal funds rate is now 4.5%. Banks are like, cool, we can lend out now at 7 or 8%, but we're going to have to pay our depositors for 3, 4, or 5% now, because in order for us to lend money, we have to have that money, some of it, on deposit. So if we don't make deposit rates attractive enough, then that means that we can't lend money and make money. Hopefully you're following that chain of events. I promise you that is one of the biggest formulas and philosophies in investing to make you successful. What is it costing me to have my capital, or to attain that capital, or to hold on to that capital? Where do I need to put it to get more of a return than it's costing me? And what's making the investment I choose work? How long will it work roughly? What is it going to earn me? How does it work? What's making it work? Not rocket science, but detrimentally important. I hope this all made sense. Please comment down below if you have questions, if you're confused. I would love to shoot smaller snippet videos to cover any individual topics that you may be confused about or not following. I understand it's a lot of information, so don't be shy about it. Drop it in the comments. Let me know your thoughts and engage with the video. I promise you I'll accommodate you in another video with some breakdowns based on your comments and questions. I appreciate y'all tuning in an attempt to elevate your financial position and increase your prosperity, increase your net worth. As always, I enjoy bringing you this content. To all my pioneers out there, I want you to stay focused, stay in motion. I'll see y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.